What's up, guys? Omar here, broker and CEO of Alden Mortgage and Ome Realty. So we're going to go ahead and answer a loan question that everybody asks. The difference between a conventional and an FHA. 3.5% down, 3% down. So on a conventional loan, you could go as low as 3% down currently in May of 2022. And with an FHA, we're at 3.5%. Now, what's the difference between the two? Now, an FHA is a little bit more stringent when it comes to an appraisal. There's something that's called an amendatory clause that's entwined with the contract. What's an amendatory clause? An amendatory clause just means, like, for the sake of argument, like, let's say you guys went into contract at $500,000. At $500,000, the appraisal came back at $520,000. When you go into contract and you get an offer accepted and everything, and you go into the lending process, you have to put up something that's called an EMD, an earnest money deposit, or we like to call it a good faith deposit. And then if the appraisal or anything happens in the course of the whole entire loan process where it doesn't fall in the guidelines of FHA, appraisal comes in too high, the inspection just goes completely sour, because FHA has a really very stringent appraisal. If something's wrong and the seller is like, you know what, I'm not going to go ahead and do it, they do not get to keep the earnest money deposit. They do not get to keep it. In a conventional side, yes, if you do not come to terms with whatever that the real estate agent has, put into your contract. And usually there's like a float in there. There's, different types of clauses that you go ahead and put into every single contract to go ahead and either protect side A or side B. And if the contract doesn't get fulfilled on one side versus another side, then they get to keep the earnest money deposit. It just is because you, the buyer, did not fulfill your agreement on the contract of purchasing that said property for whatever price that you want, up to however much that you thought that you might go to if there was any type of agreement. But for the sake of argument, what we're going to do in this video is we're going to go ahead and price out a conventional loan and an FHA loan, and we're going to put them up together against each other to see which one actually makes the most amount of sense. Now, currently, you can't go down to 3% on an FHA. It's 3.5%. On a conventional, you can go down to 3%. But so we could keep everything on an even keel. We're going to go ahead and do a $500,000 purchase price, 700 credit score, and we're going to do 3.5% down, just so we can keep it apples to apples, and we can't go any off. And you can kind of see what the dramatic difference in interest rate is, but does it really make that much of a difference? Because the mortgage insurance that you have to pay, the upfront premiums that you have to pay on FHA. So is it really worth the headache to go with an FHA? Which by all means, I do like FHA. I am a big FHA guy. It's a great program, especially if you want to protect yourself as far as buying a house that's not too shot up and crappy. But let's go ahead and price these damn loans out, and then you can kind of see. But for the sake of argument also, I'm going to go directly on the wholesaler site to show you exactly the price. And honestly, if I didn't even tell you, you wouldn't know the difference. But the program software that we use, I can't navigate around other people's personal information. It's going to be way too difficult. And, privacy issues. I don't want to mess up anybody's personal information, put it out there in the world of YouTube. That's just stupid. So let's go ahead and price these sons of bitches out, and you can kind of see exactly what we're talking about. All right, now here we go. This is going to be the loan information portion of this whole entire kit and caboodle. This is what you would call a drag and drop Fannie Mae 3.2 file here. So what is a 3.2 file? Even though this means nothing to most of you, 99.99% of people that are actually maybe even watching this video or will end up watching this video, we usually go with the 3.2 file, which is the old way of doing things. And then something else that's called a 3-4 file. Now, whenever you go, majority of mortgage companies, mine included, we go ahead and have like a login portal for you to go ahead and put your personal information, your liabilities, your assets, and everything like that. That's just called a 1003, or an electronical version of, the whatever. I don't know if that's even the right word that I use, electronical, whatever. To upload, it's a 3.2 or a 3.4 file. So what we do is you go to my website, I'll go ahead and grab that file, and then I'll go ahead and put it in here. But we're going to go ahead and price this guy out real fast. I'm going to go ahead and make myself the loan officer as well. And of course, I am the company. I am the loan officer. I am the broker and CEO of this company. So you can see right there. Okay, so what we're going to do is we're going to do test as the borrower. And we're going to price out two different mortgaging products, which is going to be a conventional and an FHA. So those are the two loan programs that we have. We are going to go ahead and not have a second loan. Now, whenever we do have down payment assistance programs that we do. Down payment assistance just covers the additional amount that you had, like the 3.5%, and then just put it on a second. So out of pocket, you would have nothing, but you will end up paying for it. But just so you guys know, a second loan amount, that'll be right there if we ever had to do that. So the sale price is going to be at $500,000. Appraisal value is going to be the same amount, and we are going to go ahead and do this loan to value at 96.5%, so we could kind of keep an apples to apples situation going on here. Now we are going to do, the purpose of this is going to be to purchase the home, primary residence, single family residence. We are not going to touch condos because condos become a bit of a pain in the ass. And that's only because there's something that's called a warrantable and non-warrantable condominium. But to keep things on the simple end of things, I don't want you guys to get too confused on a lot of the extras. This is going to be the most simplest way to do it. We're just going to do a single family residence that could be attached, detached, whatever it is. It just has to be a single family residence. Number one units is just going to be one because we're not going to complicate the situation. I'm going to do California. We're just going to go to the last zip code that we had, which is going to be in Los Angeles for the last loan we sold to this company. Monthly income, I'm just going to do, typically we have an average of $10,000 monthly income for purchasing a $500,000 house. So we're going to do $10,000 right there. Monthly debt, we'll do $1,000. That's going to be like, car payment or couple of credit cards. Taxes annual, we'll just ballpark it at $13,000. Homeowners insurance, $1,200. That's $100 a month. Sounds about right. Mortgage type insurance, we're going to go ahead and put buyer paid mortgage insurance. That's going to be, you can do a lender paid too, but it's just ultimately you always end up going to pay for it. So let's just keep this, not even mess with it. We're not going to mess with the construction or self-employed. We're going to assume you're a W-2 employee. Now, this is something that's really important, okay? So this is what's called a lock period. This is a 30-day lock period. Now, what is a 30-day lock period? That just means that if the loan does not conclude and get funded within the 30 days, you have to pay. So this date is one of the most extremely important days in the world of mortgaging and for you if you're going to purchase. So whenever... So whenever you're looking, whenever you are getting into the mortgage part of it, and you end up getting into contract, because a real estate agent has nothing to do with the purchase of a property. They hand off the reins to us when we get here, and that's all they do. They don't know shit about mortgaging. They don't know anything. They're just there. They might pretend like they do, but majority, even the high volume real estate agents or brokers, they don't know anything about most of the lending side of things. So when we ask you and we harp on you and we're kind of like, we need this, we need that, we need X, Y, and Z, it's because if we don't, and we don't get that type of information that we need, we will go ahead and expire past this fund date. This is everything that it has to be funded by this date. And if it doesn't, you have to go ahead and pay for it, which is it's a bad situation for everybody. And hopefully you don't have to go through it. Hopefully you have a broker that knows how to do something, or a bank, or whoever you're working with that knows what they're doing to go ahead and make sure you close by then. Now, compensation payer type, this is for me. This is going to be whether I want the lender to pay me. Now, I have a pre-negotiated rate with every single wholesaler that I sell to. I say, okay, I am going to make this much per each loan, which every single broker has. That goes into the whole entire thing. Now, I find it very weird and a little bit douchey for me to go ahead and tell you how much I get paid for each one. So I'm going to go ahead and do a borrow paid, which this is actually a good segue into a conversation to have as far as, borrow paid versus lender paid. On a lender paid, when you look at your loan estimate, you will not see the origination charges. That's something you will not see because that gets entwined with everything inside of the contract, and the lender, the wholesaler itself, will go ahead and pay me. But let's say, for instance, you want me to go ahead and compete with some sort of other lending company. I will have to change this to borrower paid. Does that mean that you're paying me or it's going to cost you more? Absolutely not. And I'll go ahead and show you what I mean afterwards. What I do is I will go ahead and see, can I go ahead and lower my compensation rate just to make sure that I fulfill this file and lend to you? And if I choose to do that, then yes, I will go to borrower paid. And then I'll show you in a little bit what I mean as far as this is not a bad thing. To see the origination charges and not to see the origination charges, it doesn't really matter. But I'm just, this is important. This is very, very important. So documentation type is going to be full. We need all your kit and caboodle. We need all that stuff. And I'm not going to go ahead and bore you with any more of this other stuff. Let's just get on with it. Let's see if we could get a quote on this, because I think that's probably the most important thing. Is you want to see the difference in cost between one versus the other. So what we're going to do is, number one, the pre-populated interest rate at the lowest cost. So what it does for that interest rate, that purchase price, we always get the one that's going to cost relatively almost zero or just a little bit above that. So currently we're sitting at 5/12, 2022. The interest rate on this is going to be at 4%. The final price of that is going to be at 0.116, which you are going to see right over here. The base price right here, total loan amount, interest rate, all that other good jazz. Now this, the finance mortgage insurance, this is your upfront mortgage insurance that you will have to pay that gets tied into your loan on every single FHA loan. This is just something that they have. This is for the loan down payment. This is what you have to pay in addition to, and it just gets tossed into your loan amount. Does not affect anything else like your loan to value or any of that other stuff. This is just something that's already predetermined, and you're just gonna have to go ahead and pay it. So principal and interest is going to be at $2343.84, and that'll be at $339.03 for mortgage insurance. Your total payment, and that's because we're going to go ahead and look at the taxes at $13,000 monthly debt. We're not going to worry about that, and the homeowners insurance. So between these two, that is going to give us this little guy right here, which is $3866.20. That'll be your payment on an FHA 30-year fixed at a 4% interest rate. Okay, now we're going to go ahead and go to the conventional side to see what we get pre-populated on a conventional side. So on a conventional side, they're all pretty much going to be the same. Now, son of a bitch, that's a big bit of a jump right there. 4.75% on a home-ready conventional. Now, this is going to be all the same kit and caboodle. Nothing is going to change. Everything, like as far as loan amounts and everything like that, but is it going to be that big of a difference? Now I'm going to go ahead and show you one thing, because I showed you the borrower paid versus lender paid. Now, for instance, we will go ahead and sell this loan right now at 4.75%. We are not at 4.75%. What we do is we'll go ahead and sell this at 5%, and then that'll this hypothetically could be. This could be like our commission check for this product. If we wanted to compete, if we wanted to get a lower payment, if we want to go ahead and, undercut a big market and just go ahead and give these at pennies on the dollar, that'll be the total cost on origination charges, which if we went to borrower paid and we had to go ahead and adjust our compensation, you will end up seeing this amount as total origination charges. It's not bad. So for instance, right now, everybody out there and their mother is selling at between 5.5 and 5.3 and 5.6. I even heard some companies charging at 6.2, 6.3. This will go ahead and let you know on a $500,000 loan, that's going to be the commission on that. Yeah. So at 5.5%, that's where you're at. Just so you know that, it's not always a bad thing to see a borrower paid, because would you rather have it at 500 or 5.5% and not see this? Or would you rather have it at this and see this? They're like, okay, this dude is making $3,000 off of me. You know, it's not the best, it's not the worst. You know, 3,000 is not that much money. It's very little, but you know, this is a hookup deal. He's gonna go ahead and take care of me on this one, but he's gonna give me a 4.99%. That's great. That's awesome. But let's go ahead. That was just, you know, I had to go back to that borrow paid. But 4.750%. You're going to be your principal and interest payment, which is going to be right here. Principal interest, that's P&I, that's going to be at $25,1695, which at $25,16, your total liabilities on your homeowner insurance plus your taxes and your principal and interest will be at $39,2947, which will give you, it's like about a 60-something dollar difference. So in the normal world of conventional, this 4% to 4.75% is a pretty big difference, because look, let's see, if we're at 4% here on your principal, we're going to look at this number right here. At 4%, we're going to be at, that's almost a $200 jump. It's a really, really big difference between the mortgage insurance from one to another and how much you're actually paying. So 4.75%, is it really worth it for you to go ahead and not take the 6% or the $67, $68 difference and make sure that you close on a loan using a conventional loan versus an FHA? Now, by all means, I don't care. It's the same thing regardless for me. But this is something to keep in the back of your mind, that this is exactly, you know, how much it would cost a 4.75 on a conventional versus a 4% on an FHA. FHA is a great loan product. It's usually cheaper, and in this case scenario, it is cheaper. But at what cost? Like if you're going and you know pretty much if you're going into a house and you're like, this is not that great, we're gonna have to do some fixing. If you utter the words, this house is gonna need a bit of a sprucing or whatever it is that people use nowadays, then just remember FHA is probably gonna go ahead and ding you on it, and it's probably gonna just be a big pain in the ass. But let's go ahead and stop this recording thing, because I think I pretty much did everything that I was supposed to do. And then let's close this guy. And that is the difference between a conventional loan and an FHA loan, and what the cost breakdown is between one versus another, other versus another, and then which one makes most sense to you. So hopefully I explained it out as best as I could. If you want me to go into detail about something else that I didn't go and you're a little bit more curious, or you had a scenario where you want me to price things out for you, please comment below. I'll be more than happy to help you out. So for up to 50% commission rebate, 0% listing on selling your current home, or any mortgaging assistance, link in the description below. If you like the content, like, subscribe, comment, help me out, help somebody else out. I really appreciate you guys watching. Yeah, if anything else I could go ahead and talk about, please let me know. Comment below. Until next video, guys, I really appreciate you watching. Peace.